SpaceX is going public on June 12 with the ticker SPCX, an evaluation of $1.75 trillion. When it lists on NASDAQ, it will be the largest IPO in history, and the $75 billion raise would be more than double the previous record holder, compared to Saudi Aramco's $25.6 billion offering in 2019. Interestingly, Starlink, SpaceX's satellite internet division, generated $11.4 billion in revenue last year with a 63% adjusted EBITDA margin. That is better than Apple's hardware margin, better than Google Cloud's operating margin, and better than almost any infrastructure business at comparable scale. By that measure, SpaceX has built one of the highest quality recurring revenue businesses on Earth. Yet at the same time, SpaceX reported a GAAP net loss of $4.94 billion in 2025. The company is being offered to the public at 94 times trailing revenue. When Saudi Aramco IPO'd at a similar valuation, it was generating $164 billion in net income. SpaceX generated a loss. Still, both of those things are true. The question for retail investors is whether Starlink's cash machine justifies buying at a price that makes every other IPO in history look cheap by comparison. My name is Phoebe, and you're watching Trading Key. The actual investment case. Strip out everything except Starlink. Let me start with the bull case, because it's real and deserves to be understood precisely before we get into the complications. Starlink is the only broadband provider on Earth that can reach a customer anywhere with no physical infrastructure at the delivery point. No cables to lay, no cell towers to build, no regional monopoly to negotiate with. You point a dish at the sky, and you get internet. That simplicity is why it has 10 million active subscribers across 160 countries, and why it is adding between 750,000 and 1.5 million new users every month. Unit economics tell the other half of the story. $11.4 billion in 2025 revenue at a 63% adjusted EBITDA margin generates $7.2 billion in EBITDA. That figure alone would make Starlink one of the most profitable telecom businesses in the world if it were standalone and public. Revenue growth compounds automatically as SpaceX launches more satellites. The constellation already has over 10,000 inches low Earth orbit, targeting up to 34.4K, meaning coverage density improves without proportional cost increases as it fills out. The thing is, no competitor is close. Amazon's Project Kuiper is the only credible long-term rival, and its commercial deployment is still in early stages. Continuous coverage requires roughly 1,600 satellites. Kuiper has a few dozen today. SpaceX is 3 to 5 years ahead on satellite count, and the window for a competitor to close that gap while Starlink is simultaneously improving its network and signing 10 million customers to hardware and subscription commitments is narrow. Then there is the launch business. SpaceX flew 165 Falcon 9 missions in 2025, more than every other launch provider on Earth combined. Its market share in global commercial launches is approximately 82% by payload mass. Falcon 9 has a 99.5% mission success rate across 650 cumulative launches. No competitor can undercut SpaceX on price, because SpaceX's internal cost to launch a Starlink satellite is under $28 million per flight, while its commercial list price is $74 million. It is profitable at prices that would bankrupt a rival. If you strip out everything else and ask what Starlink alone would be worth as a standalone public company, growing at 40% per year with 63% EBITDA margins, the answer is a great deal. The complication is that you cannot buy SPCX and only own Starlink. The number nobody is telling you about. In February 2026, Elon Musk merged xAI, his artificial intelligence company, into SpaceX. The combined entity is what is going public as SPCX. That means when you buy SpaceX stock, you're not buying Starlink and rockets. You are buying Grok, X, and Musk's entire AI infrastructure build-out bundled in. Now, this is the number that changes everything. XAI burned approximately $14 billion in cash in 2025, while generating only $3.2 billion in revenue. That $10.8 billion gap is what turned SpaceX from an estimated $791 million profit business in 2024 into a $4.94 billion net loss business in 2025. Starlink's cash generation is being consumed by the XAI buildout, and the S1 does not tell you when XAI reaches profitability or what its target burn rate looks like by 2027. This matters specifically for retail investors because other channels might frame it as a Starlink investment with some rocket upside, but truthfully, that framing is incomplete. You cannot separate the two pieces. There is no SPCX share class that gives you Starlink without XAI. The governance structure, which we will get to in a moment, means you also have no mechanism to push back if the XAI cash burn continues longer than you expected. The bull case on XAI is that Grok eventually challenges OpenAI at meaningful scale, and the AI business reaches profitability within 2 to 3 years. If that happens, the combined entity's earnings profile accelerates sharply. The bear case is that you are funding an indefinite AI arms race with no visibility on the timeline, drawn directly out of Starlink's EBITDA, and the $14 billion burn rate continues or grows as GPU compute costs increase. Both outcomes are genuinely plausible, though the S1 gives you limited data to distinguish between them. What you actually own, and what the price assumes. Two things that rarely get covered in the hype videos: what governance rights you are actually purchasing, and whether the valuation makes sense at any reasonable set of assumptions. On governance, think of it this way. Buying Class A shares in SPCX is like owning seats at a shareholder meeting where all the deciding votes belong to someone else. You attend, you hear the results, and you leave with no ability to change the outcome. SpaceX uses a dual-class share structure where Class A shares, which public investors receive, carry 1 vote each, and Class B shares, held by Musk and early insiders, carry 10 votes each. Musk holds approximately 42.5% of equity, but controls approximately 85.1% of all votes. If he approves a transaction that benefits XAI or X at the expense of SPCX shareholders, public investors cannot block it. If the board wanted to replace him, it could not succeed without his consent. The S1 also reportedly includes mandatory arbitration clauses, significantly constraining shareholder legal recourse. You are buying a minority economic stake in a business where one person makes every meaningful decision. On valuation, at $1.75 trillion, SPCX trades at approximately 94 times 2025 trailing revenue. 3 data points give you the clearest sense of what the market is pricing in. Aswath Damodaran, the NYU professor widely considered the most rigorous valuation practitioner in academic finance, ran a full DCF on SpaceX and arrived at $1.22 trillion as fair value. At the IPO target price, you are paying a 43% premium above his estimate. Morningstar called $1.5 trillion expensive but not irrational. PitchBook's fair value range is $1.1 trillion to $1.7 trillion. Every independent estimate sits below the IPO price. The historical comparisons make the premium concrete. Meta debuted at $104 billion in 2012, was profitable at IPO, and fell 38% in its first 6 months. Saudi Aramco debuted at $1.7 trillion in 2019, with $164 billion in net income, and fell 15% in its first year. Uber debuted at $82 billion in 2019, while loss-making, and fell 35% in its first 6 months. SpaceX is pricing above all of them. At a net loss, at a revenue multiple, none of them came close to. Buy, watch, or avoid SPCX? The honest answer depends almost entirely on your time horizon and your tolerance for volatility. For a short-term trade, the risk is asymmetric against you. There are actually 2 index inclusion catalysts to watch. Nasdaq's fast entry rule already took effect in May, which means SPCX could be added to the Nasdaq 100 within weeks of listing. The bigger question now is whether S&P Dow Jones approves a similar fast track for the S&P 500. If it does, roughly $24 trillion in passive capital tracking the S&P 500 would be forced to buy. As of the recording of this video, that S&P rule change is still under review and has not been approved. But the 180-day lockup expiry in December 2026 brings $40 billion or more of insider shares eligible for sale. Every major loss-making IPO in the past decade has seen its real entry point 6 to 12 months after listing, not on day one. Buying at IPO price for a short-term hold has historically been the worst entry in deals of this type. For a 5-year hold, the thesis is coherent. If Starlink reaches 50 million subscribers at $75 per month ARPU, it generates $45 billion in annualized revenue with exceptional margins. That is a completely different earnings profile than what exists today. If XAI reaches profitability in the same time frame, the loss that currently obscures the underlying business disappears. The valuation premium you are paying is essentially a bet that both things happen. The risk is that one or both takes longer than the market expects, and the stock re-rates downward in the interim, with no governance mechanism to accelerate the correction. So, 3 things to watch before June 12. First, Starship Flight 1-2, which is scheduled to launch on May 21. As of the recording of this video, it hasn't yet lifted off. A successful flight will be a positive catalyst for the roadshow. A failure or further delay creates immediate pre-IPO uncertainty and tests whether Musk's execution narrative holds. Second, the S&P 500 fast-track ruling. The NASDAQ fast entry rule is already confirmed, meaning SPCX enters the NASDAQ 100 conversation immediately. The bigger mechanical catalyst, whether $24 trillion in S&P 500 passive capital gets forced exposure, is still under review. Watch for that decision before June 12. Third, the roadshow commentary starting around June 4, specifically what management says about XAI's path to profitability and the Starlink ARPU trend. Average revenue per user fell 18% between 2023 and 2025 as SpaceX expanded into lower-income markets. If that decline is stabilizing, the subscriber growth numbers are as impressive as they look. If it is continuing, revenue growth is slower than subscriber growth suggests. My read? Starlink is a genuinely exceptional business. SPCX at $1.75 trillion is not a Starlink investment. It is a Starlink plus XAI plus Musk's full vision investment priced at 94 times revenue, with governance that gives you no voice if the vision diverges from your expectations. If you want exposure, the history of mega IPOs says, wait. The lockup cliff in December 2026 is a more rational entry than June 12. So, where do you land? Are you getting in on day one, waiting for the lockup dip, or sitting this one out entirely? Let me know in the comments below. Thanks for joining me today. If you found this video helpful, remember to subscribe to Trading Key, give this video a like, and share it with a friend who might just benefit from learning this too. With that, I'll see you in the next one.